Welcome back, students who are taking financial accounting, and in this series of videos we are talking about the theory portion for chapter 9, which is on current liabilities and long-term debt. Okay, so let me get to the slide here. In this video we are going to talk about estimated warranty liabilities. All right, now get my pen. This here is relatively simple, okay, and you'll see why. Right? Normally, the common warranty period is 90 days or a year, but warranty periods can vary. It all depends upon the item or whatever have you. Whenever you go to the store and they ask you, "Oh, do you want to take an extended warranty?" Or I noticed that on like Amazon, if you buy certain items that are not like books and DVDs. Like let's say, for example, I just bought a humidifier. Well, a pop-up asked if I wanted to get an extended warranty on it. Well, just one second here. Okay, so we're all familiar with warranties in and of themselves. Okay, and generally, if you want one, you pay for one. It's sort of like insurance, so that quote unquote you don't have to pay for the major repair all at one time, but instead you're paying little by little by little by little over the course of time. And to be honest with you, buying warranties doesn't make sense financially. I mean, why would a business offer a warranty? The reason why they offer the warranty is that they're going to make money on it. I mean, they've done their studies and they know what the average cost of the repair is going to be. Okay, and so what they're doing is they're going to offer you quote unquote this insurance, this warranty, in order so that when it comes time, you don't have to shell out for, say, let's just say $1,000 for the repair. Instead, what they're doing is they're whacking you for $50 a month, right? And when you think about that, over 12 months at $50, right? That's $600 a year, right? Well, they're offering you a 3-year warranty, so by the end of the let's say it's a 3-year warranty, so that's you're going to pay $1,800 over the course of that 3 years. Okay, now they're offering the warranty over that period of time, and chances are that that piece of equipment is going to break down after the 3 years. Okay, so if it breaks down during the 3 years, yeah, you're paying this $50 a month, but you're not, when it breaks and costs $1,000, you're not going to be shelling out $1,000 because quote unquote you haven't put the money aside in order to pay for it, right? Or you don't have that money aside. It's easier for you to go and pay the $50 every month. People can seem to handle that, but they don't realize that it's costing them a hell of a lot more on the warranty. So just as an FYI, and this is basically what I do. I mean, I budget, to be able to cover those expenses. Like for example, when like for car expense, right? I take and I don't buy the warranty, but I put aside $100 a month every single month, so that when I do have a big expense on my automobile, I've got the money put aside. But that's called budgeting, and that's not the purpose behind this this video. But anyway, so warranties, me personally, I never buy them, all right, because it costs more money. And what happens if you don't use it? That's just money down the drain, okay? Warranties prey on your fear of having to pay whatever that large amount is when it comes time for that particular repair, right? But financially, they don't make sense. The only sense that it makes is for the company offering the warranty. I mean, they have to stay in business. They have to make money, so they're making that extra money off of you. But anyway, all right. So with that said, that was just a personal opinion. The matching principle requires a warranty. The matching principles requires that the warranty expense to match the same period that the revenue related to the warranty is recorded. Remember, the matching principle says we want to match up our revenues with our expenses in a particular accounting period, TG period. Okay, so that's what we're doing here. We have to match up the warranty expense to the revenue that's related to the warranty. So if I have a warranty, and if the company is charging $50 a month for the warranty, right? They're booking that revenue of $50. Okay. Now, that doesn't mean that you're going to have an expense in that particular month. Okay. So that's where this idea of estimating our warranty comes in. All right. In that the matching principle says we have to match up that revenues with the expenses. So I might be collecting this revenue for 1 year, right? Okay. And that means $600 has come in revenues that have not had any expenses matched to them. But then let's just say the warranty period goes from 1/1 all the way to 12/31, right? So every month we're paying in this 50, 50, 50. We're not matching any of our revenues. Okay, so we're not matching any of our expenses. So our revenues are, our profit is overstated for 12 months, but then when we hit December where we put in $50 and now all of a sudden we have $600 of expense, okay, that's mismatched, okay? So what we're doing is we're estimating that warranty so that we could spread it out over the warranty period, all right, in order to, stay within the guidelines of the matching principle of saying revenues match our expenses. So this $600 expense, what we want to do is we want a portion of it, estimate how much it is and expense it, each and every accounting period to match the revenues as we generate that revenue. So that's the idea behind the matching principle and why we're doing what we're doing here. Okay, so we estimate the amount of the warranty expense and offset with the estimated warranty payable. So that is estimated warranty payable is a general ledger account. Okay. And what we're doing is we're estimating the warranty expense. So however you go about estimating the warranty, that's up to that particular business. Generally, the way that works is, and there's no set rule to this, okay? You have to, you have to look at what makes the most amount of sense for that particular business. But generally, what will happen is, let's say over the course of 1 year, right? Let's say the business historically, okay, and I'm just going to make up some numbers here, historically has $12,000 in expenses, right? Now, let's say that the company offers, the warranty, and over the course of a year, they collect $120,000 of revenue, warranty revenue. Okay, so you take the 120,000, okay, and divide it by the 12,000, and you get 10%. So generally you come up with some kind of percentage, all right, that you apply each and every accounting period, and you offset that to the warranty payable account. And the best way to think about this is it's very, very similar. And again, we're going by association here in order to be able to learn this concept. It's very similar to, booking your bad debt expense. In the previous chapter, you remember you had an uncollectible account, right? For your bad debt. Right? And whatever method you used, you were estimating your bad debt expense. Okay, so what you ended up doing was you ended up booking your, your bad debt expense, and you were offsetting it against the uncollectible account. Okay, and then whenever you had, whenever you were able to collect something, it went against the uncollectible account. You didn't have to mess with the bad debt expense again. You're always, you were dealing with that uncollectible account for bad debt, right? It's the same exact type of thinking here, where you're estimating, what your warranty expense is going to be, okay? And let's just say, based upon, that you have 10%, all right? Well, you estimate your 10% for that particular, against whatever that revenue for that particular month is. And let's say that's 15,000, right? Is what you're collecting in revenue. Well, 10% of 15,000 is 1,500, right? Well, I'm going to put the 1,500 against warranty expense for 1,500, and then I'm going to credit my estimated warranty payable for 1,500. Okay, so that puts my expense into my payable account. Now, whenever I actually have to pay something out, whether it's in via cash or by replacement, which would then come out of inventory. Okay. Whenever I have to do something like that, I'm going to debit my estimated warranty payable account, and I'm going to credit either my cash or inventory for whatever amount that bill was for. Okay. let's say that amount was, I'm just going to call it, say, $250. Just making something up here. Okay, so $250, and let's say we're going to pay that customer cash instead of replacing it. Okay, so that would be my entry when I have to pay out the cash that's being covered underneath that warranty. So that offsets this estimated warranty payable. And yes, that estimated warranty payable account is always going to have a running balance in it, just like our uncollectible account had a running balance in it all the time. All right. And yes, periodically you do have to look at what your percentage is going to be. I mean, you might do that once a year. Okay, you're certainly not doing it every accounting period. The same as with your uncollectible accounts. You estimate what your bad debt expense is going to be, or using whatever method that you're going to use in order to determine what your bad debt is. Well, you're doing the same exact thing. You're going to use whatever method that you can use to determine what your estimated warranty payable is going to be, and you update that amount, or that percentage or whatever, on a regular basis, regular being like every year, 2 years, really not 3 years, or, you don't really get into 3 years as much because it can change, but generally like once a year, you'll figure out what your new percentage is or whatever, and you'll use that as the basis for making your estimations. Okay, so I hope that made sense. Relatively simple. Again, think about uncollectible accounts, and if you think about that, then this becomes relatively easy. Okay, as an overview, a quick summary before we're done with this video. Let's say you take in 15,000 in revenue. Okay, and historically, that generally you've figured out that you're estimating 10% of whatever that revenue is what your expense should be. So you take 10% of the 15,000 and you get 1,500. Then you make this journal entry to book the 1,500 against warranty expense, right? Warranty expense for 1,500, and estimate estimated warranty payable for $1,500. So that this here entry to the warranty expense matches your revenue, right? Because you're taking in $15,000 in revenue, right? Now you've moved that to the payable account, okay? And depending upon whether you pay out in cash or replacement, which we would generally have some type of inventory for, whenever a claim goes against that warranty, we take it out of the estimated warranty payable and we offset it with either that cash or that inventory account for whatever amount that is. All right. And that's basically it. All right. It's not any more complicated than that. Like I said, associate with the uncollectible accounts for bad debt, and you have, the theory, the knowledge, the understanding of the concept as to how it actually works. Except instead of working on the asset side, we're working on the liability side. All right. So if didn't understand that, obviously reread the textbook, but pause and watch the video again. And if you still don't understand it, feel free to contact an instructor, and we'll go into a little bit more detail if we have to on it. Okay. So until then, see you in the next video.